Hey everybody, happy Friday once again. I'm back with another chart chat. I really hate that term. I need to come up with something better. Um, Markets have been volatile. They've been tough. This year, especially for most of our clients, especially, I recognize this particular event with Iran. It's more meaningful, not more meaningful. It's been a more difficult thing to stomach because leading into it, we our portfolios were performing wonderfully, significantly outperforming the S&P and everything else. Um, and because of that kind of peak to trough, if you will, this event has been more noticeable if you're the type that looks at your portfolio on a regular basis. I don't encourage you doing that. I recognize that you do. It's a human behavior. I get it. But understanding that everything going on right now is creating a lot of uncertainty for everyone. One of the things that we can do is we can go and look at how the market's digesting information, and we can get a bit of clarity on at least what is perceived to be the accepted truth and perspective on what's going on. I bring that to mind because one of the things that I don't think enough people are calculating into or including in their understanding of what's happening around the world right now is, even though you may not have any experience with it, behind the scenes, in your mind, we're now in a world where generating truly false visual information is readily available. We also have outlets and sources where we can see things that, kind of you trust with your eyes sort of thing, right? That's the old way of being. And now you have to question that. Am I watching a real video or am I watching artificial? Something that's been generated. How do I know? Right? That's a new problem that we face. And we've known about it, we've thought about it, we've talked about it, but now it's becoming it's actually impacting our understanding of things going on around us. And because of that, it creates a dissociation in our minds where you trust even less. And lack of trust, lack of sources to trust, it's really hard. It makes life painful. That's actually a measurable thing. We know that. We can measure that humans, generally speaking, we feel discomforted to a higher degree as our ability to trust anyone, frankly, goes down. And therein lies some of the problems with like those that suffer with like schizophrenia, or other issues is they're they don't know who to trust anymore, and that causes even more problems. And we're facing that's tough. And I don't think we can really overstate how difficult that is. But with that, one of the things we can trust is we can go to markets and at least know that markets are going to tell us what everybody else is collectively arguing over, where they think the most or least impact is. And I say that because it doesn't necessarily give us the human side of the truth, but it at least helps us discern the economic considerations that are being had. So I'm going to pivot and go over just a couple quick charts here. I'm going to make this as short as I possibly can so that it's just something that can help, again, continue to create a framework and a context. That being said, over the course of the past week, 2 weeks really, you've seen shifts in your portfolio. You've received trade confirmations. Really what we're doing is it's kind of a threefold approach. We're not making any major changes because we are right at critical support levels, for lack of a better word, and we don't want to sell until we violate those, because if we're selling without violating critical support levels, we're not actually investing with a discipline. We are guessing on the future. Now, does that mean we have to give something back to the house? We lose portfolio value? Yeah, we do. We absolutely do. The problem is you don't know when you're at the top. You never know what you're at the top, because once you're at the top, that may not be the top and you may continue going up. You know you're at the top once you've already been there and you've already begun a descent. The question is, how far do you descend before you say it's time to, exit, stage left, stage right, whatever it might be. And in this case, we are kind of reaching that point where we now have exit doors available to us. We're looking at them, but we need to make sure that it's valid. We need to make sure that we're making that decision. But I do want to highlight the fact that we've been making some little changes. Some of it's carving off for tax reasons and taxable accounts. Some of it's carving off individual positions that may have violated a support level, and we need to reduce those positions because they violated the short-term support. Or it may be simply we're starting the process of repositioning, and we can't go all in on it, because if we did, we would be surrendering our discipline. And at the end of the day, good investment is predicated on good discipline, and better yet, critical discipline adherence. And I will not deviate from the investment discipline that I maintain, because it is proven over time. Doesn't mean that you're going to be exempt from any downside. That's not the way it works. That's not how investing works. What it means is we are long-term investing based on clients, based on risk profiles or risk tolerance. In other words, risk comfort zones. We have to be disciplined in times like these, because this is when you have to trust the process, because otherwise you're going to let your emotions take hold and they're going to take you to the wrong place. I sent out the 2026 market outlook video with a distinct purpose in mind, to frame this year as a year of extended volatility, high volatility. It's going to be a bumpy ride. Here we are. It is already a bumpy ride. That is to be expected. Understand that, know that, have that expectation as we continue forward, because doing so will help you then better navigate or kind of trust the process as we move forward. Okay, with that being said, let me transfer over here. I'm going to bring up a couple screens and we're just going to talk about a few things. Okay. First things first. This is going to be one of those, and I'm not trying to lead. I guess maybe I'm going to give you bad news first, and then I'm going to kind of look at what could be good news. We'll see. We'll see. But I'm bringing up these two charts here to highlight an important thing that we have to keep in mind. Oil is front and center in everybody's mind right now. There's no doubt about that. Go to the gas pump, you know it. It's always funny. When oil prices were so suppressed, my gas prices really didn't go down. And now oil prices are way up and my gas prices went up. It's kind of like taxes, right? Even when you tell me I get a tax cut, I'm still paying a lot in taxes. What's the deal? There's like, I'm sure a Seinfeld skit or something built in there, but like that's the nature of this beast, unfortunately. Okay. But what's more important to understand, and you can barely make it out in this, I kept it very, very light because I didn't want it to be something that you're, too drawn to automatically. But understanding the fact that one of the things that oil does in an economic environment, oil is a massive force. I'm going to use force. The reason I say that is oil is not only because of, well, we can go back in history. I won't give you the whole history, but it should be known. Standard Oil, going all the way back to the basically departure from the old ways and the emergence into the oil age. Most of our economic expansion actually has its roots in oil one way or another, be it pharmaceutical supplies, be it chemical industry, be it, sadly enough, the food industry. The reason that matters, though, is because as we're looking at oil, oil is truly, and I hate to say it this way, it is a lifeblood of so many industries. On the surface, of course, we have energy costs to heat, cool, whatever else it might be, that we're using energy for. You go a layer down, and of course, the energy that's required to transport materials. There's a very direct correlation. We all kind of think about that. But if the cost of moving the goods goes up, and if those goods are not produced immediately, very local, okay, be it farmed product that has to come from the Midwest to the Northeast, right? Or crap made in China that Americans are addicted to buying. Either one, you need energy to move it, okay? So if oil prices are up, guess what happens? It translates into those products. Take it a step even further than that. Oil distillates and oil byproducts are used in so many facets of our lives, be it the makeup industry, excuse me, pharmaceutical industry, food production industry. Doesn't matter. Oil is everywhere. So while we are seeing oil on the surface, it's like, oh, well, only China uses the Strait of Hormuz or Hormuz or however you want to say it. I'm not going to pretend like I know how to say it right. But the Strait of Hormuz, most of that oil that's passing through there is going to China, going to India. It's not coming to America. It doesn't matter because it's going to price into the economy across all of those other contexts. So we zoom in and we say, what happens when oil has quick run-ups? Because what it does is it causes an entire economy to have higher prices. It's not inflation, though. It's an important thing. It's not more money chasing less goods. That is what inflation is. More money, big fat money. It is a price, and that's why they try to remove oil prices when they talk about things like CPI. That doesn't mean that oil, I disagree with the Federal Reserve removing oil and energy costs as a part of CPI because energy is also very much subject to inflationary pressures. However, in this case, this is a supply constriction. Okay. Doesn't mean that the supply is not there. The oil is still there. This isn't like they mined all the oil. There's plenty of oil. It's the oil reaching the market is constricted. And that in turn causes a supply demand imbalance. And there's some price elasticity, but generally speaking, it's not that great because of the carry-on effects. So we go back in history, and I'm going to take us actually all the way back here. Okay. So we've got crude oil futures here at the top. We've got the S&P 500 down here at the bottom. Okay. Look back in 86. Okay. Good year. That was a very good year. Good vintage. Okay. We see oil starts this little ascent. But you know what? I need to put it into a better context. Let's zoom it in so that we can take out some of these, right? We had this major fall off in 85 to early 86, but then oil has this kind of rebounding move. And guess what happens here in 87? That's the flash crash, Black Monday, whatever else you might want to call it. Now, did oil prices going up cause this? No, but it created structural weakness that made markets and the economy less durable to other effects, to other problems. You get these crashes. Now, notice here, right? Oil shoots up in 90 and comes right back down. So it's not this prolonged, protracted. This starts in June of 90, it ends in February of 91. Okay. Did the market go down? Yeah, the market still went down. Didn't go down precipitously, didn't go down to a great degree, went down about 20%. Still a lot, like, don't get me wrong, but this wasn't cataclysmic, but it was recessionary. But I'm going to come back to this one in a minute. There's a reason I made that yellow. Let's move forward here. Let's go into the early 2000s or the late 90s. Look at what happens. You have this big move in the S&P 500, but look, oil's pretty well flat across this period of time. Okay, but then we start to get this ascent. And guess what? That ascent is prolonged. We go from 98 all the way to 2000. We have a 2-year prolonged period of higher oil and increasing. It's not just higher, but higher and increasing. Rate of change on pricing around oil is the most important part of this. We have the run up here. And then what happens? We have the tech crunch. Because the pricing of everything else is higher, because oil is higher, we have structural weakness. So it takes takes resiliency out of the market. It doesn't crash the market. It makes the market less resilient to other things that crash the market. Okay, that's the takeaway. Look, here we are. Now we have a huge buildup in oil going to '06, coming out of '03, going to '06. Big buildup. Do you know why? You might remember. We had a war on terror and weapons of mass destruction and everything else. Okay, that drove oil prices up. But then here in '06, we get this kind of fall off in oil, but no action from the market. So we can have prolonged periods of slowly increasing, but it goes back to the rate of change. Okay. But then after things cool off, they ascend pretty rapidly here, right? Looking up here into, let me press the right button here. Haha, there we go. Right. Big rapid ascent going from the bottom of '07 up to May of '08. Guess what happened? Boom. We had 2008. The market was less resilient. Okay. Fast forward once again. Here we are in 2020. Guess what? Here's our coming, both everything went kaflooey with COVID, right? And shutdowns and everything else. And you'll see this big skinny tail here. That's where I've talked about it before, but oil, people basically, nobody wanted it. So the futures traders were like, no, I don't want delivery of oil. I want another futures contract. The futures market was like, nah, you got to take delivery. So they're like, wait. I don't know where to put all this oil. I got to put it somewhere. So it created basically oil went to negative pricing for 2-3 days. It wasn't real. It was artificial, but pass that aside. Okay. You might say like, look here, oil had this ascent from July 17 up to 18. And guess what happened? We had the Christmas crash of 2018. Did it cause it? No. There was liquidity crisis. There was reverse repo window we had midterm elections. There was a whole lot of other things that happened there that caused the market to have that crashing. But the structural weakness was there because oil prices were up. All right. Here we are, 2020 to 2021. Guess what happens with oil prices? Here we are once again. Massive, fast ascent in oil prices created structural weakness. Did it cause the market to crash? No. Inflation and inflationary disastrous policies by Fed, Congress, you name it. And then, of course, they have to raise rates to try to battle inflation because they said it didn't exist, even though it did. And we had talked about that, and I'm done tooting that horn. But yes, then we had the 2022 selling period here. Okay. Because there was weakness in the market because prices were elevated. Now, what I'm going to call this period here in the S&P, this is the glut of AI fueled frivolousness post-COVID. We had this cooling period, but this is the debt, the consumption glut. That's what we've been in. Everything's debt driven. Everybody's kind of consuming. Our, economic cycle is definitely in a period of uncertainty. This ascent in oil is troubling. Going back here to 1990, though, this other yellow period, those of you old enough to recall, you will remember this was the Gulf War. Okay. Somewhat similar to what we're dealing with right now in immediate nature. Is it a perfect proxy? No. But I think that this is something we can glean a lot of insight from. So as we go forward, if we don't see a retraction in these oil prices fairly soon, what we're going to do is we're going to bake in structural weakness. It's like the steel substructure of the market is rusting fast. And it's almost like this is spraying vinegar on it, and it's causing it to rust even faster. All right. So we need to see this cool down. Now, is it cooling down? Yeah, this is a weekly chart of oil, right? It's cooling down a little bit. We've spiked way on up. It's cooling down a little bit. But as of right now, we don't have any indication that it's going to be cooling immediately to a precipitous degree. We would like to see that. Okay, so that's their bad news. Now, let's go over to some good news. One of the key principal pieces in the puzzle that I talked about in the last chart chat video is that the dollar and the ascent in the dollar was what was hurting our portfolios the most. It hurts not only the commodity space, but it also hurts the international investments, which we are heavy in. Now, we use hedged international exposure, but when it comes to the commodity space, we can't really hedge it, okay, for currency problems. We're not going to go and buy gold in another country's currency. We're not going to do that, okay? But where the positive note is look here. We came right up, and this is a line in the sand that I drew, and you can go back to old videos of mine. This has been an important, significant resistance support level for a long time. And we came right up to it, and now we are seeing lower highs and lower lows, right? So let's put that into, okay, a high, a lower high, right now, lower high, a low, a lower low. I want to see that continuing. That is positive news. That will be constructive for our portfolios. That'll be constructive for our investments. That helps us say, hey, how are those positions doing? And should we get out of them? Well, not yet. Have they violated a support? No. Okay, should we still get out of them? Maybe they're going to go down even more. Not yet. Okay. If this pops back up and beats out these highs, okay, yeah, we might need to. Or let's go over to the S&P 500 for a minute here. I'm going to put the bars back on because it's very important to note key level of interest. Let's make this chart a little bit easier to digest. This key level of interest, this was the support that I had put in the market in the last video. I said, once we get down to here, it's time to be a little bit more concerned, a little bit more worried, but not until we get here. Here we are. Yesterday, we opened right at, that just is a confirmation. This is a key line in the sand. The market just told us, hey, you're right. You said you thought this would be. Now, yeah, it is. Okay. Here we are today, this daily candle bar that you're seeing here. Okay. Yeah, we're below that level. Okay. Can we hold it? Possibly. We'll see by the end of the day. If we don't, we basically start a 3-day clock where we're going to be watching this for the next 3 days. If it can't get back above that level and maybe find it just battling along that line for the next couple weeks or something, we need to see it get back. We need to see the buyers come in and say, no, the market is undervalued. We don't agree that it's not, this is priced too low. We're buying it back up, and we get back above that level. Okay, that's going to be another check mark on positive news, positive developments. If we don't, though, that's going to put us into a position where we're going to really need to start reevaluating overall domestic equity exposure. Now, I can look at something like EFA, and I can say, wow, EFA's really taken a hit. This is the international MSCI EFA index, represented by the EFA ECF. It's an iShares product. But it's just one that we can use it as a proxy, or I can come over here and I can just use an index, an actual index. This is the FTSE Global All Cap ex-US Index. All right. They tell two different stories. And there's a reason for that. The EFA tends to concentrate more on US correlated international exposure. The FTSE Global has a little bit less of that correlation. So like Japan is usually what it has a lot of Japan, has a lot of Europe in the EFA. Here, we're getting a little bit more of the rest of the world. And we can see that this uptrend, right? Here's kind of one of our support levels, our key line, right? We're coming down to it, but we haven't crossed through it. Okay. Now on EFA, yeah, I'm granted tracing out a much smaller chart, but if I were to, take it back to the same time period, okay, we're a little closer to that level for EFA, okay, but we still haven't violated it. So this trend is still very much intact. And that's not even to say if it violates this, it's broken down completely. It's just telling us, and this is, it when in doubt, zoom out. What if I look at this on a weekly basis and I put it into a line chart? Are we still in an uptrend? Yeah, look, we went down, we battered around down here, and we shot up. Yeah, we're probably still in an uptrend. What if I look at it on a monthly basis? Are we still in an uptrend? Yeah, we're still in an uptrend. Okay. We don't want to be running for the doors yet. Okay. So that's looking at the international space. Now, one that I do think warrants some additional attention is the metals in the commodity space. Okay. Here's crude futures. We just talked about those just a minute ago. Look at where they are. Disregard the lines here. These just, yeah, they're significant, but they're not as significant as just that massive ascent. But let's price crude in gold to help strip out the problem that the dollar creates, which is the inflationary mispricing problem. Okay. What if I priced it in something that doesn't change in value, like gold? Okay. Look at where we are. We're right in this key area where I had marked it long time ago. This actually came into play about in September of 20 is when this zone of interest came into play. And look, we got down into it. We kind of broke below it. We came back up into it. We have a pretty good idea of where oil can run to. And if it runs to it and goes above that, we got problems. If it goes to it, comes back down, it's okay. All right. So this is what I'm watching here. When I see this relationship, when oil prices as a respects relationship with gold, when it prices up above this level here, getting out of this yellow zone, that's where I'm going to be a bit more concerned about the price of oil and that structural integrity problem economically. Okay. Let's look at gold for a minute. Wow, gold, it had a heck of a run here, going all the way back to 22, right? November of 22. Now, why is gold selling off, right? Gold should be this place where people pour into, what we talked about in the last chart chat. But one, no, they actually, in short term panics, they go to the dollar, they go to treasuries, they go where they think it's safe, or they're right now, you're also seeing companies or countries, excuse me, and people going into other economies looking for sovereign safety, right? Buying debt from governments. But the other thing with gold is a lot of the gold buying that's been going on is a result of extra cash on hand and not feeling safe keeping it in cash, not feeling safe keeping it in the government of anything, but especially the US government by way of treasuries. Well, right now, that extra cash isn't available anymore. So some are eating into their gold and saying, all right, well, that's why I have gold as a store of value and I need it right now. So I'm going to go sell some of my gold. Okay. But we're still holding the line in the sand. And this particular line in the sand is very relevant. And it's one that I'm watching very closely. You'll see intraday, we traded down to it. We pop back up. Today, we're holding. Okay. I want to keep seeing that. We still haven't got enough signals to say, start dumping gold, start dumping miners, start dumping anything. In our portfolio, yeah, these positions have taken a beating, but those are the same positions that had us rocketing up way above just a month ago. Okay. We need to have clear evidence that these things are actually breaking down and it's not just short-term panic selling or situational selling that's going on. We don't have evidence of that yet. Last but not least, I'm just going to quickly highlight two additional considerations. And before I do, I'm just going to mention here, if I were to really draw back on this gold chart, right? Here's 2016, right? 2015, 2016, we saw this big drop off in gold, sell down. I've talked about this a lot in the past, but really it's going from August of 11 down. It had gone up because of 2008 economic. The feverishness around gold happens after the economic instability happens. Because most people are like, oh, I'm not a gold bug. Gold's not safe, blah, 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 blah. Well, that's fine. It's like there's also no atheists in a foxhole, right? It's after you're already in war, then all of a sudden you start praying kind of thing. That's the argument there. With gold, people flood into gold after the economic problem has occurred. And we see it over and over again, right? Here's 2000. Come on, let's zoom it out. All right. So gold stays suppressed 96, 98, 2000. It kind of pops up a little bit. If I were to, I need to probably scale this into a log scale just to show the effect of that. October of 99, there was a big spike up in gold. Yeah. Sells down even when the market's selling down. But then afterwards, They start buying. And then here we are. Look at 2007. All right. No, I'll give them credit. There was some buying going on there leading into it. Then the sell off occurs because they need liquidity. They sell their gold. But then after the event occurs, all right, time to push gold prices back up, push gold prices back up. All right, why do I bring that into to mind is without even talking about inflation, okay, or the inflation problem. Generally speaking, during calamity, gold sells. After calamity, gold gets bought up. Well, we're sitting with nice gold positions, but I'm not going to sell it right away with no violation. And in the event we end up getting through this and this calamity ceases, what happens next? People start pouring back into gold, right? Does it happen this time? I don't know. Things can change, but we're willing to change our mind. But the other part of it is the inflation problem. Here is our 2020 sell down as inflationary premises are brought to the table. Fed policy is absolute trash. Okay. Congressional policy is absolute trash. Print money, shut down economic activity. It's just garbage. Okay. But then when the pivot occurs, right, here's where they start raising rates. And oh, I don't have my cool demonstration thing on. Here we go. Right here is where they're raising rates and gold's falling off. But then they stop raising rates. And look at what happened to gold. Okay. Now, are they going to raise rates right now? Probably not. Because again, it goes back to the oil problem. We've got structural issues. If you raise rates right now, that puts even more pressure on the economy. That would collapse the economy, especially with that structural issue of oil at hand. So do I have a feeling they're going to raise rate? No, not at all. Not at all. But might they need to discuss it? Well, let's look. Here's our inflation indicator. This is basically what the market perceives about the future of inflation. And it's basically a relationship between TIPS, or Treasury inflation protected securities, versus Treasury securities. Treasuries are going to go down if rates go up. Inflation protected securities are not. So you'll see money piling into TIPS, or Treasury inflation protected securities, when there's a fear that inflation is going to be going up in the future. Look at what we're doing here. Going right back up. We started in December into February, but then no, everything's going to be okay because we're going to get a new Fed chair and there's not going to be inflation. But then war happened. Now, is war creating it? No. But is war inflationary long term? Yes, it is. It absolutely is, because governments do really stupid things like print money to go make more stupid weapons to kill people. I'm sorry. It's just the nature of the beast. But the inflation question remains. Now, that'll play back into our metals. It'll play back into our commodities as a cycle. And it's going to further reinforce the fact that, yeah, we are in a very tepid, tenuous, volatile world as it relates to markets. Navigating it is not an all in or all out thing. It's one of those where we're going to be patient, measured, and disciplined. So, with that being said, I'm going to cut myself off here, even though I could talk about a million and one other things. I'm not going to. Maybe it'll be next week, but I hope this has been helpful. Give me a second here. There we go. Okay. I hope this has been helpful. I get uncertainty creates stomach aches. I can't control what the president's doing or who he's doing it for. I can't control, unfortunately, any of that stuff out there. And in most cases, neither can you. What we can control is our perception of things, our expectations, our discipline, of course, but more importantly, your immediate domain, the world that you actually live and operate in. And I know I leave you with this same similar message. It's the same sentiment I want to always share with people. There's plenty to be worried about in the world, and I don't blame you for being worried about it. I'm worried about plenty out there. Try your best to focus your attention on what's immediately in front of you, your family, your friends, your loved ones. Be the best possible person you can be in your community. If everybody's doing that, and instead of cheering on the killing of other people because they think differently than you, if everybody stopped doing that nonsense, chances are we wouldn't have these uncertainties and these problems, at least to the degree that we're having them now. But it's easier said than done. I get that. In the meantime, I hope that this is helpful to give you framework for understanding the little changes that we have made, but more importantly, why we're not making big changes yet. But we also have a very clear, distinct line in the sand where changes are going to have to happen. And if they do, yes, in taxable accounts, there's going to be tax ramifications. I'd rather pay a little bit in taxes, unfortunately, even though it's not going to be used constructively. But unfortunately, I'd rather be able to pay some taxes because we've locked in some gains and we're not exposed to further downside than ride the wave all the way down and then sell at the bottom because we've just simply reached our end point and then not get back into the markets when the inevitable opportunities arise. Because at the end of the day, humans are awesome. By and large, there's unfortunately thin tails of really, really, really super amazing, awesome people. The majority of people are awesome. And then there's this other tail of awful cretins, most of which are actually sociopaths, or at least, or probably in more cases, psychopaths. And because of our system, we tend to elect them into public office because they seek out power and control and whatever else. But they make really awful decisions, right? But most people are awesome. And the creators are going to create, the builders are going to build, the designers are going to design. And we find our way through these problems despite those skinny ones that, for whatever, the skinny tail problem people that we tend to elect into public office, regardless of political party. Okay. Try to ignore those people. Let's just stay focused on what's right in front of us and what we know. And if you have questions, if you want to talk about your portfolio, if you want to talk about your plan, if you want to talk about your job, if you want to talk any of that stuff, retirement, you have concerns about, Social Security, anything like that, give me a call. Let's talk it through. Because if you have a little bit better certainty, you're going to have a higher degree of confidence and not worrying and being, perturbed and that type of thing. So let's talk about it. But in the meantime, have a wonderful weekend, and I'll talk to you all soon.